Hello, welcome to LCG's preview for the week ahead. I'll be discussing the escalation of tensions in the Syrian civil war, crude oil prices hitting 3-year highs, the latest on the US-China trade war, a deluge of UK economic data, and just a quick take on Netflix earnings out after US markets close on Monday. Now before that, I'll run down some of the top corporate results to watch this week. On Monday, it's Bank of America and Netflix reporting Q1 earnings. Associated British Foods report half-year results, and Goldman Sachs reports for Q1 on Tuesday. Rio Tinto offers a sales update, and Heineken, Morgan Stanley and American Express report Q1 results on Wednesday. On Thursday, we get sales results from Unilever, Nestle and Publicis, then quarterly earnings from Sky and Mattel. And then finally on Friday, we have sales update from Reckitt Benckiser and Q1 earnings from General Electric and Procter & Gamble. Moving on to the economic calendar, there is US retail sales on Monday, China GDP as well as retail sales and industrial production, UK unemployment and German ZEW on Tuesday, UK CPI, Eurozone CPI, and the Bank of Canada rate decision on Wednesday, Australia unemployment and UK retail sales on Thursday. Then we round off the week with the IMF meeting on Friday. So purely from a sort of uncertainty perspective, the Syrian war has been weighing on markets. I would say actually equities as a whole have held up relatively well given the potential risk in this scenario. I think there's just an underlying belief that, again, Donald Trump is trying to do some deal making rather than actually looking for a hot war with Russia, which obviously, needless to say, has all sorts of terrible implications. So hopefully things will back off in Syria, but obviously for the time being, it's a risk factor. Tweets and official comments are flying back and forth. My guess is that there is going to be some sort of aerial bombardment from the US, perhaps even over the weekend. That may or may not be supported by the UK and France. But hopefully by that time at least, Russian troops will be well out the way and hoping that there will be no shooting down of any missiles that do go across and the implications that has just for that geopolitical tension. Now, while most markets suffered because of that, actually oil prices did very well. We saw 3-year highs in both Brent and WTI crude. We're basically testing the breakout here. So $70 in Brent, a little bit lower in WTI. These are key resistance levels. If we can close the week above here, then actually bodes very well for perhaps a new bullish uptrend in oil prices. But where we stand at the moment, very much key. The fact that this is based on more like geopolitical tension probably gives slightly less weighting to the breakout than if it were based on just pure underlying oil market fundamentals. We did hear from OPEC last week, and it was interesting that actually while OPEC continued to cut their output, world oil supplies are going up, largely as a result of the increase in production in the US. So you could go so far as to say that the impact of the cuts in production from OPEC and Russia combined, the impact of those is starting to drop. And obviously oil prices are heading higher, but we're going to get to a flipping point at some point soon when the market starts to pay attention to this growing chance of a new supply glut probably going into 2019, and they start to factor that into oil prices rather than just this geopolitical tension. As far as the US-China trade war, again, lots of flipping back and forth. The latest seems to be a conciliatory tone from the US and China, particularly for tweets from Donald Trump, and we had President Xi's of China's speech last week, which had a generally conciliatory tone, but afterwards we had officials from China saying that actually China still would match any extra tariffs suggested by the US with specific US products and services being targeted. So it looks like China will still go tit for tat. And something that Larry Kudlow raised, the economic advisor to the White House, was that actually we may even see some tariffs imposed temporarily while trade negotiations are taking place. Now, needless to say, that isn't a good thing for companies trying to make investment decisions. And so that actually could start to curtail, at least in the short term, on economic growth. We have got a lot of UK economic data next week. There are the likes of retail sales and the unemployment rate, but I think the most important one will probably be earnings growth and how that relates to inflation growth. So what we saw last month was that based on the inflation data as of February and the wages based on November through January, actually inflation's at 2.7%, wage growth at 2.8% annually. So, there is no squeeze on the cost of living if you include bonuses. So it remains to be seen, and obviously the critical factor here will be whether that squeeze is reduced further, or if in fact we see the ratchet turned up again on UK consumers, because we're already seeing a notable effect on the high street and difficult results from the retailers. And last but not least, we have earnings from Netflix next week. The shares are up 50% year to date, which is quite astonishing given the kind of volatility that we've seen, notably to the downside in the benchmarks. As we speak, the S&P is down about 5% for the year. So obviously a massive outperformance. I think part of that you can attribute to still a strong underlying belief in Netflix's business model. They're spending on content, which is drawing in new subscribers. So their message is that content is still working. Something that perhaps is going against that story is that there was some rumours that Netflix was looking to buy a billboard company. So obviously that would suggest a bit more spending on marketing rather than content. Maybe the content isn't doing the job by itself. But nonetheless, that doesn't seem like too much to read into at the moment. And I'd just say the other factor here is that obviously it's a technology company, but it's not a part of this data collection scandal that's engulfing the likes of Facebook and other companies like Google that use advertising as the main source of their revenue. Obviously Netflix is a subscription-based model, not based on advertising. So all expectations are that subscriber growth and revenues will grow at a faster pace than last year. So obviously that bodes well for growth for the company. Obviously the next step is increasing profitability, but the assumption being that naturally as costs come down, subscribers growth increases, then the profits will follow the metrics we just mentioned. Right, thank you very much for watching, and good luck with trading for the rest of the week. Of course, if you do like these videos, feel free to follow us on YouTube and social media.